Hello everyone, welcome back to the channel. Today we are not just talking about money, we are talking about a philosophy that has defined generations of wealth. We're going to dive deep into the money-making skill, a blueprint for financial independence that isn't about luck, guessing, or quick tricks, but about a very specific, learnable mindset. If you've ever wondered how the legends truly build their empires, or if you're tired of the financial noise and looking for a real, sustainable path to success, you are in the right place. Let's break it down. Warren Buffett's approach to wealth is often misunderstood as a stroke of genius or simple luck, but it is actually a highly refined, teachable, and replicable skill set that anyone can master if they are willing to put in the work. To truly understand this, we must first strip away the frantic noise of Wall Street, the daily volatility of stock tickers, and the get-rich-quick schemes that plague the internet. We need to focus on the bedrock of long-term value creation, the disciplined application of rational thought to the world of finance. The journey begins with the profound concept of the Snowball Effect, which stands as the fundamental principle of all long-term wealth accumulation. Most people, unfortunately, view money through the narrow lens of consumption, a tool to acquire immediate goods, status symbols, or fleeting experiences. Buffett flips this flawed script entirely. The core philosophy here is that money is not an end in itself. It is a seed. If you plant it with care in fertile soil and let it sit undisturbed, the miraculous power of compound interest takes over. This process is not about getting rich quickly. It is about getting rich predictably and reliably. The mathematics behind this is simple, yet the psychology required to execute it is incredibly difficult for the modern investor. It demands the discipline to bypass the short-term dopamine hits of luxury spending for the quiet, slow, and compounding growth of long-term assets. Next, we must address the massive, often misunderstood chasm between speculation and true investing. Many participants in the financial markets are merely speculators, often without realizing it. They look at a ticker symbol, watch a chart jumping up or down, and react with emotional urgency to every headline. This is not investing, it is sophisticated gambling. A true seasoned investor views a stock as a fractional ownership of a real business. If you cannot explain exactly what the company does, how it generates its profit, and why its business model remains sustainable for the next decade, you have no business owning that stock. When you decide to purchase a company, you should ask yourself a critical, gut-check question. Would I be perfectly comfortable owning 100% of this business if the stock market were to close entirely for the next 5 years? If the answer is no, then you are speculating on price movements, not investing in value. This leads us directly to the essential concept of the economic moat. A business without a significant moat is fundamentally vulnerable. In a free market system, competitors will eventually notice high profits and move in to eat into that market share, destroy margins, and render the investment worthless over time. A wide, deep moat consists of durable, difficult-to-replicate competitive advantages. This could be a powerful, unshakable brand identity, a cost advantage that others cannot match, or high switching costs that make it incredibly painful or inconvenient for customers to move to a competitor. The focus remains on identifying companies that possess these unique, rare qualities. These are the businesses that can withstand harsh economic downturns, periods of rising inflation, and rapid disruptive technological changes. You aren't looking for the fastest growing startup, you are looking for the most durable, battle-tested business. However, having the right investment philosophy is practically useless without rigorous emotional regulation. The financial market acts like a manic depressive pendulum that swings wildly between irrational fear and unbridled dangerous greed. When everyone is panicking, the price of high-quality assets drops, often far below their intrinsic value, creating a buy signal for the rational investor. When everyone is exuberant in buying everything in sight, prices inflate far beyond what the business is actually worth. The investor's greatest enemy is not the market itself. It is their own human temperament. You must be able to think independently, often going against the prevailing sentiment of the crowd. When others are paralyzed by fear, you must have the courage to buy. When others are blinded by greed, you must have the discipline to sell or simply hold cash in patience. This leads us to the crucial circle of competence. One of the most dangerous things you can do in your financial life is to invest in an industry you do not fully understand. Buffett stays strictly within his circle. If he doesn't grasp exactly how a software company's complex revenue model works or how a specific financial derivative is structured, he walks away without a second thought. He doesn't view this as a missed opportunity. He views it as a major mistake avoided. You must spend your time and energy mastering a few specific areas. Read incessantly, study the annual reports, understand the competitors, and know the industry leaders better than anyone else. By building your own intellectual moat, you drastically reduce your risk of failure. Finally, we arrive at the realization that long-term success is not a sprint. It is a marathon of consistency. The skill of wealth creation described here is effectively an exercise in patience and absolute rationality. It is the boring work of reading annual reports, the quiet work of thinking deeply about business models, and the disciplined work of waiting for the right moment to act. You do not need to be a genius with a high IQ to build lasting wealth, but you do need to be consistently rational. If you can maintain this mindset, if you can treat your finances with the same respect you treat your life, and if you can stick to the fundamental principles of value investing, the result is almost mathematically guaranteed. Wealth is not created in the fleeting excitement of a trade. It is created in the quiet years of holding and the decades of compounding. The game is long, and it is played entirely against your own impulses, not against the market. Keep your focus on the underlying business, keep your emotions in check, and let the unstoppable power of time do the heavy lifting for you. Introduction to Part 2. Welcome back. In our first session, we established the bedrock, compounding, the economic moat, and the necessity of rational thought, but understanding that what is only half the battle. Today, we enter the engine room. We are going to deconstruct the how. How does an investor actually execute these principles when the market is screaming, when fear is rampant, and when the pressure to act is overwhelming? Today, we go beyond the theory and into the specific mechanics of preservation, the discipline of inaction, and the structural integrity of wealth. Let's dive deep. Part 6, the mathematical imperative, rule number 1 in the margin of safety. Most people treat investing as a game of offense. How much can I make? Buffett treats it as a game of defense. How can I avoid losing? Let's look at the math because it is unforgiving. If you have $100 and you lose 10%, you have 90. To get back to your original 100, you only need an 11% gain. That is manageable. But if you lose 50%, you are down to $50. Now you need a 100% return just to get back to where you started. The deeper the hole you dig, the harder it is to climb out. This is the tyranny of loss. This is why Buffett insists on the margin of safety. Think of this like building a bridge. If you know the truck crossing the bridge weighs 10,000 pounds, you don't build a bridge that supports exactly 10,000 pounds. You build one that supports 30,000 pounds. That 20,000 pound gap is your margin of safety. In the stock market, you do this by never paying full price for a business. You wait for the irrational dip. You wait for the moment when the market's fear drives the price significantly below the intrinsic value of the business. You aren't buying the ticker, you are buying the asset at a discount. By doing this, you aren't just protecting your capital, you are creating a buffer against the unpredictability of the world. Part 7. The Masterclass in Inaction. The Psychology of the Fat Pitch. We live in a world of constant noise. Financial news, social media, and trading apps are designed to make you feel like you're falling behind if you aren't doing something. But in the Buffett framework, the most profitable action is often no action at all. Buffett uses the baseball analogy. The stock market is a no-called strike game. You can stand at the plate for hours. You can watch the fastballs, the trendy tech stocks, and the curveballs, the speculative volatile assets go by. You don't have to swing at them. You can wait for the fat pitch, the slow, easy ball right down the middle, which represents a high-quality company trading at an incredibly low price. The struggle here is psychological. Humans are wired for action. We feel productive when we move. But in investing, movement is the enemy. Every time you trade, you incur costs, taxes, and the risk of being wrong. Developing the discipline to sit on your hands while the market is manic, to watch others chase gains while you patiently hold cash, is the ultimate competitive advantage. This requires a level of emotional detachment that most people never achieve. You must define your own success not by activity, but by accuracy. Part 8. The Complexity Trap. Simplicity as an Intellectual Moat. There is a dangerous misconception that complex wealth requires complex methods. Wall Street wants you to believe this because complexity allows them to charge you fees. But Buffett's track record proves the opposite. If you cannot explain your investment to a 12-year-old, you don't understand it well enough. Complexity is a hiding place for risk. Derivatives, leveraged financial products, and opaque hedge fund structures are often designed to obfuscate the truth of how money is actually made. Buffett focuses on simple businesses. He wants companies that sell insurance, food, electricity, or logistical services. These are the boring businesses. They are predictable. They are essential. When you invest in a simple business, you have a much higher predictability quotient. You can forecast their cash flow 10 years out with a reasonable degree of accuracy. When you move into complexity, you move into the unknown. And in the unknown, you are not investing, you are hoping. True wealth is built on the foundation of boring, predictable, and simple cash-generating machines. Part 9. Look through earnings. The true measure of wealth. Stop looking at the stock price. The stock price is merely the temperature of the market. It is not the health of the business. Buffett uses a concept called look through earnings. He treats the companies he owns like a private family business. When you own a private company, you don't call your broker every day to ask what the business is worth. You look at the balance sheet. You look at the cash flowing into the bank account. You ask, is this business expanding? Is it increasing its market share? When you start viewing your portfolio through this lens, the daily volatility becomes irrelevant. If you own a high-quality business that grows its earnings by 10% a year, it doesn't matter if the stock market crashes tomorrow, the business is still growing. The volatility isn't a threat to your wealth. It is a feature that allows you to buy more of the business when everyone else is panicked. This mindset shift is the moment you stop being a trader and start being a capital allocator. Part 10. Integrity as the ultimate compounding asset. We must end on the most important variable in the entire equation, you. Buffett famously said, it takes 20 years to build a reputation and 5 minutes to ruin it. Many people see business as a game where you cut corners to get ahead. That is a short-term strategy with a catastrophic long-term failure rate. Integrity is not just a moral virtue, it is a business strategy. When you are known as a person of your word, when your handshake is your contract, when you prioritize the truth over the quick buck, you create a reputation moat. People want to do business with you. You get the first look at the best deals. You get the trust of partners. You get the loyalty of employees. This creates a network effect of success that is impossible to replicate with money alone. Your integrity compounds just like interest. It attracts better opportunities, better partners, and more stability. If you compromise your values for a short-term gain, you are effectively shorting your future. You are telling the world that you are a liability. Build a career of honesty, and the wealth will naturally follow. Closing, the final synthesis. We have dissected the money-making skill in excruciating detail. It isn't a secret formula hidden in a vault. It is a set of rigorous, boring, and highly disciplined habits. It is the patience to wait for the fat pitch. It is the wisdom to avoid complexity. It is the courage to buy when others flee. It is the discipline to preserve what you have worked for. And above all, it is the character to stand by your principles. The market will try to make you frantic, emotional, and complex. Your job is to stay calm, rational, and simple. This is the long game. It is a game of subtraction, subtracting the noise, subtracting the fear, and subtracting the ego. If you can do that, you aren't just building wealth, you are building a legacy. Thank you for staying with us through this deep dive. Now it is time to put these principles into practice. Start small, think big, and stay disciplined. The compound interest of your life begins with the choices you make today. Welcome back to the final chapter of our deep dive. We have traveled far. We started by building the foundation, the mechanics of compounding, the necessity of the economic moat, and the critical importance of rational emotional regulation. We then moved into the engine room, dissecting the margin of safety, the discipline of the fat pitch, and the sanctity of character. But if we stop there, we have only learned the tactics. Today, we are going to explore the spirit of investing. We are going to look at the philosophy that separates the person who has money from the person who understands wealth. To be a true architect of your own financial destiny, you must answer the questions that most people are too afraid to ask. What is enough? How do you view risk when the world is burning? And what is the ultimate purpose of the capital you are accumulating? This is not just a lesson in business. This is a lesson in living. Let's bring it all home. Part 11, the psychology of enough, escaping the hedonic treadmill. The most dangerous trap in the world of finance is not a bear market. It is the hedonic treadmill. This is the psychological phenomenon where we constantly chase more cars, more status, more zeros in our bank account, only to find that our baseline happiness never rises. Buffett's greatest triumph is not his billions. It is his ability to define enough. Many people look at Buffett's frugality and call it odd. I call it clarity. When you understand that money is a tool for freedom and not a scorecard for your ego, you stop making foolish decisions. If you are investing because you need to prove your worth to your neighbors, you will fail. The market has a unique way of punishing those who bring their insecurities into their portfolios. To think like a master, you must be able to say, I have enough. When you reach that point, your decision-making changes. You stop taking unnecessary risks to make extra money because you no longer fear not having enough. This allows you to play the long game. The investor who is not driven by desperation is the most dangerous competitor in the market because they can wait until the world panics and then, with total calm, step in to collect the assets that the desperate are throwing away. Part 12, the macro-micro paradox, why we ignore the news. If you want to be a master of the money-making skill, you must learn to live in a state of deliberate ignorance regarding the daily news cycle. Every morning, the financial media bombards you with forecasts, inflation, interest rates, political shifts, global tensions. They want you to believe that if you don't pay attention to these macro events, you are being irresponsible. Buffett's stance is radical. If you need to know the state of the Federal Reserve to make an investment, you don't have an investment, you have a guess. The Buffett philosophy dictates that you focus on the micro, not the macro. You look at the business itself. Does the business provide value? Is it essential? Does it have pricing power? If the answer is yes, then the daily news cycle is irrelevant. When the market drops because of a macro headline, the rational investor sees a gift, a lower price for a business whose fundamentals haven't changed. The amateur sees a disaster and sells. Remember this, the best businesses in the world are built to withstand economic cycles. If your investment thesis relies on the economy being perfect, then you aren't investing in a great business. You are gambling on an environment. Ignore the noise. Focus on the engine. Part 13, the diversification myth. Why focus wins. We have all heard the old mantra, don't put all your eggs in one basket. This is excellent advice for someone who has no idea what they are doing. It is the advice given to those who are too lazy to do the work of researching a company. But for the investor who has done the deep, exhaustive work of studying a business, diversification is essentially diversification. When you buy 50 different stocks, you are mathematically guaranteeing that you will achieve the average return of the market. You are also ensuring that you will never truly know what you own. How can you have deep conviction in 50 different business models? You can't. Buffett's approach is to find a few high-probability fat pitches, companies with ironclad moats, incredible management, and long runways, and put a significant amount of your capital into them. This doesn't mean you take reckless risks. It means you only invest when your probability of winning is high. If you find a company that is going to be dominant for 20 years, why would you take money away from that winner to put it into a mediocre company just for the sake of diversification? True safety does not come from owning a broad index of everything. True safety comes from owning the best things. Part 14, the Lindy Effect, Why Classics Win. There is a concept in economics called the Lindy Effect. It suggests that for non-perishable things, like ideas or technologies, the longer they have already survived, the longer they are likely to survive in the future. If a book has been in print for 50 years, it will likely be in print for another 50. If a company has been a dominant force for 30 years, it is likely to remain dominant for another 30. This is why Buffett invests in companies like Coca-Cola or American Express. These aren't trendy experimental startups. These are businesses that have survived wars, depressions, and technological revolutions. They are classics. In the world of investing, novelty is usually a synonym for risk. Everyone is chasing the next AI, the next EV, the next crypto. But the most reliable way to make money is to invest in businesses that have already proven they can survive the test of time. When you invest in a company that people have been using for decades, you are betting on human nature, and human nature rarely changes. Stop looking for the new thing and start looking for the proven thing. Part 15, Risk as a Defined Reality, Volatility versus Permanent Loss. We need to redefine what risk means. Most people believe risk is volatility, the up and down movement of the stock price on their screen. They think that if their portfolio value drops by 20%, they are risky. This is a fundamental misunderstanding of the market. Risk is not the movement of the price. Risk is the permanent loss of capital. If you buy a business for $100 and tomorrow the market says it's worth $80, but the business is still making more money than it was yesterday, you haven't taken a risk. You've been given a discount. You have only taken a risk if you were forced to sell at $80, or if the business itself is structurally flawed and will never recover. The market price is a mood, not a fact. When you have a strong balance sheet and no debt, you are immune to volatility. You can hold through the storm. The only people who get wiped out by volatility are those who use leverage, debt, or those who panic. If you are calm, debt-free, and owning quality, volatility is your best friend. It is the mechanism by which the impatient transfer wealth to the patient. Part 16, the legacy capital as a responsibility. Finally, we must address the why. Why are we doing this? Why all the reading, the patience, the discipline? If you accumulate wealth just to buy more things, you are trapped. The true power of the money-making skill is the freedom it gives you to leave a legacy. Buffett is one of the greatest philanthropists in history, not because he gives money away, but because he built a machine that creates value. When you master these principles, you are not just a participant in the economy, you become a steward of capital. You are allocating resources to businesses that employ people, innovate products, and serve humanity. This is a responsibility. Wealth is the ability to shape the future. It is the ability to fund education, support families, and build structures that outlive you. When you view your portfolio as a legacy, as a seed that will grow into a forest for the next generation, you stop thinking about the next quarterly report and start thinking about the next 50 years. That shift in perspective is the ultimate level of the game. Conclusion, the infinite game. We have traversed the entire spectrum of the Buffett philosophy. We have moved from the mathematical reality of compounding through the structural importance of moats and margins of safety, and finally into the philosophical necessity of character, patience, and the definition of enough. You now possess the blueprint. You know that the game is not played against the market, the news, or the traders on Wall Street. The game is played against yourself. It is a game of subtraction, subtracting the ego, the fear, the greed, and the desire to fit in. If you can hold on to your principles when everyone else is abandoning theirs, you will win. The money-making skill is not a set of instructions. It is a way of being. It is the quiet confidence of knowing exactly what you are doing, the stubborn discipline of waiting for the right moment, and the unwavering commitment to the truth. This is an infinite game. There is no finish line. There is only the continuous improvement of your mind, your character, and your understanding of the world. Start today. Read that report. Analyze that business. build your moat, and most importantly, stay true to the values that got you here. Thank you for embarking on this journey with me. Now go out there, be rational, be patient, and build your own legacy. The world is waiting.